Hey everyone, it's Ed Kime over at Quantcha, and welcome back to another day of the Quantcha Challenge. We're pretty excited today to go through some new topic stuff, as well as a new agenda that we've been working on. This is still very much fluid, so we're trying to figure out a good way to format this so that we can provide both some interesting uh, education about the tools as well as some financial theory, and of course, show you how to uh, how you might manage a portfolio with our tools. And of course, as always, recommend you check out the Quantcha Unlimited, our $99 a month full offer, which includes everything in our web tools as well as unlimited commission-free trading via your trader brokerage account. And that's what we're using here. So the first thing I wanted to cover as we get into this here is we're going to talk about very briefly the updated format. It's a very minor change. It's just a little more logical way to go about running the webcast. The first is we're going to do a portfolio review, just take a look at our positions, understand where we are. Then we're going to manage our high priority positions. For example, if we have options that are expiring or trades that we really need to deal with now, we'll get into that early on. Then we'll check in on our standing orders, anything we have that's good to canceled, that's a longer term trade, just to see kind of where we are. Then we'll place new trades. And the reason we're doing this earlier is because in the past we place the trades and then we chase it down a little bit. And I know it's a bit boring to sit there and watch somebody try to shave a spread to close out a trade. So hopefully we'll place some orders at prices we think are fair, try to get them closed, give it some time as we talk about any new discussion topics or answer questions, and then finally we will clean up anything that didn't close yet or any final thoughts we have, and then move on from there. Hopefully that'll enable us to be a much higher signal to noise ratio. So we do have an interesting topic to talk about today with our forward prices and some synthetic long stock and everything. But let's start off, as we will, with the portfolio review with where things stand now. We did our first close yesterday by rolling a Microsoft position. That's actually working out pretty well for us too. I mean, we're continuing to gain some value in that position. One thing I wanted to point out here is there's a negative number down here in our change since that talks about kind of our current positions and where they are relative to when they were opened. And this, of course, for any seasoned investor, you recognize that this isn't a reflection of how you're doing with your portfolio. This is more a reflection of just how the current positions are. For example, we took a little bit of profit off of our Microsoft position yesterday by rolling a call. It wasn't a significant amount, but the bottom line is it did help buoy us up a little bit. We started right over 26,000, so this is a better number. This total account value is a better one to look at. We started at $26,024.77. So when we do an analysis of kind of performance, that's what we'll end up using for overall portfolio return. So we're going to try to get this over 26,000 as we can. The other thing too is that our change since, because our current market value and all that stuff with the portfolio, it doesn't align perfectly with what the total account value is, because the data that we're calculating for you here in Quantcha is using market pricing, which means that we are any long position we're pricing at what the bid is, and any short position we have where pricing is that we'd have to close at the offer. Of course, you'd be able to shave that in, and I believe the total account value, which is what we're pulling in from your trader brokerage account, is calculated. It's probably calculated more based on midpoint, is what I would estimate. But just as a thing to point out, so it's just sort of one of these things. Like I said, watch this number, and that's a more accurate number of where we are in terms of our goals. Our goal was 1%, so by the end of January. So we're just trying to get this up to I think it's 26,300 or something in that range. So yeah, we got a bit of ways to go, but we're also kind of in the middle of things. Now, the positions are going, as you can see, everything's up a little bit today. That's kind of good because for us, because we have three positions here. These top three are bullish. We want them to go up. That's fine. These bottom two we're bearish on. The one that really is kind of a thorn on the side right now is the Starbucks position, because it was a weekly trade. We used it to balance our book a little bit. It provided us that balance, and we knew there was a risk. And now we're sort of at this unfortunate point with option portfolio management, which is this trade at that down point, 425 is the max loss. So if we were to sit there and hold on to it all the way to expiration and have it assigned, we would lose 425 if it were completely, if it were completely working against us. So at this point, there's not a lot of value in closing it out. The small amount of value we would get out of it versus the return we could get if it just showed a little bit of downward movement tomorrow. So I really think that if we hold on to this through tomorrow, worst case is this 425 number. So we're pretty much, unfortunately, it's a free trade at this point. Is one way to look at it. Is we're down a bunch of money and hopefully we can recover from that. But this was here in the event the market went down. We figured we would get a nice short-term gain from it to offset the losses we would take in our bullish positions. So that being said, we're not going to do anything today. This is the only short-term, high-priority thing that I was worried about looking at because it does expire tomorrow. So we're not going to touch it. The next thing to talk about is our standing orders. We have two right now. The standing orders, these are good till canceled orders that we put in place to try to make some profit. We set this at 550 as a credit to return if we wanted to close our straddle. I don't think we're that close to that right now. We can see the credit right now for the midpoint is 415. We talked a lot about this trade yesterday. I won't go into it too much, but we'll see. We're going to close it out tomorrow. Hopefully, we'll still see a bunch of movement upward, or we'll see a big movement downward. Otherwise, we'll close it. We'll take our loss, and hopefully, it's minimal. Carnival's another one. We're trying to eke out half the profit. This one might actually close out relatively early, even though we're looking at still about 4 weeks left till expiration. There's a good possibility this number here, or at least the 45 we're asking for in credit to gain half the profit, that could very well close out in the next week if we still see Carnival kind of edging upwards. I'm not really sure what we're going to do with them. I think we might come back in on it because I'm still pretty bullish on them, or at least I feel confident that they're not going to see a major drop between now and earnings. And well, we'll see what things are when the time comes. So that's that. Now, in terms of, we're not going to place new trades today, but we are going to watch a couple trades. And before we start watching trades, I want to talk a little bit about some of the financial theory around option stuff. And I'm going to try to make this more applicable to the newer option investors that I know have been watching what we're doing here. And we'll actually just take Microsoft here. And so let me switch over to the Microsoft main view. And I want to talk about the impact of dividends on option pricing. And as you might think, dividends, even though they don't fit into a Black-Scholes formula, they do fit into the binomial models and the other pricing models that are out there that account for the fact that Black-Scholes doesn't have dividend support built within it. And the main thing, it's a big discussion you could have, but the main thing we really care about is that when the dividend is going to be taken out of a stock, from the perspective of the option holder, you get no benefit from that in terms of receiving the dividend. All it really means is that when you're pricing the option, you need to price it as though it were trading at a lower price at the expiration date. And so I'm going to use Microsoft here because they have this X dividend and they've got this this point right here. Now we're going to switch over and take a look at just the forward price for the stock. And I'll explain how we calculate forward price in a second. But you'll notice that the near-term forward price is right around a little bit gain out of the money. Then we go up a little bit and we kind of stay. I mean, this is probably a little higher than it ordinarily would be. But this is some options work that we do to calculate where the market is pricing the stock to be trading at this point in the future based on options and something known as a synthetic long trade. Now, the key thing I want to talk about here is that this price here, as you can see, it goes up, and then there's a drop before the dividend, or I'm sorry, right after the dividend, and the next point that we have at our 60-day mark. Now, if we switched over to another stock, I think Exxon's another good example. Exxon, for their forward price, they also they do the same thing. I mean, they've got a bit of a drop, but you can see they drop pretty hard after the dividend. Another one, I think even Carnival has, I think they give out a dividend, and if we take a look again at the forward price for these guys, it kind of moves around a little bit, but the big drop happens after the dividend, and then it starts to move back up again. And to be honest, the reason this is low is because this is an interpolated price point between these two, and it calculates these. It's really being weighed down by the fact that there's a dividend coming out of the stock here. Now, let's talk a little bit about what that means. So ordinarily what you have is if we go to the option chain for a relatively healthy stock like this, I'm going to scroll down to the money, and you'll notice that that we have the implied volatility is around 21 at the money for this expiration for calls, and for puts it's a little over 22. Now, if we take a look at the trades, if we go back and actually take a look at some trades for for this stock for this expiration. We'll get a nice view here, and I know this is kind of hard to follow, but I'm going to turn off the implied distribution, open interest, and volume just so we see the skews here. This up here is the put skew in red, and this is the call skew in green. You can see they're very close together. And the reason they're so close together is because you're supposed to have a certain level of put call parity. You're supposed to have puts and calls be about the same implied volatility for pricing purposes. Otherwise, there's these arbitrage opportunities that come up. And a good example of the arbitrage opportunity would be if you could buy one side of a trade and sell the other side of a trade, and be able to lock in gain using options. And you can't literally be long and short the same option, but you can do a combination of trades where you end up with a guaranteed profit. And someone else obviously would be taking the other side of that, which they never would in a real world. So when I switch over here, I'm going to try to talk about this idea of the synthetic long stock. So kind of table the dividend discussion for a second. The synthetic long stock is the idea that you would buy a call at the money. And I'm taking content here from from an old video we did a couple years ago. So that's why it's a May 2015 reference to an option. But this was an example of a synthetic long for Facebook. And the idea is you buy that call right around the money. At the time, Facebook was trading around $80.50. At the same time, you sell one for one a put at that same strike. So what you're saying here is you're going to take on the risk of the stock dropping below that price with your put, and you're going to get the benefit of the stock going above the price with your call, which really is what a stock position is. Only in this case, you're opening it up with much less capital, because all you're really on the hook for is you need to buy the call. You use the put to finance it, and then of course you're going to need to put some cash on the side to support this. But if you're trading with a position where you can have short puts, it doesn't really it doesn't hurt as much as actually going out and putting the entire cash and margin. As a side note, another example of this would be the risk reversal. This is the same kind of setup, only instead of getting an at the money put that you're going to short, you go a little further out, just as to get a different risk return profile. And this will pay off, in a similar way, only you can usually get more leverage in there. Now, the reason I bring this up is that when you take these kinds of trades and you place them, what you should end up seeing is that you get a return that is comparable with owning the stock. I mean, obviously you can get more leverage, but you shouldn't get any kind of benefit from it. So like you should see sort of like in this case, we got the synthetic long in place here. And if we click through to it, you'll notice that the break even is going to be close to where the money is. I mean, there might be a little bit of cost one way or the other because of whether it's interest or whether it's liquidity, but it's going to be right around where the money is. And you could trade to switch to a bunch of different positions here and look at different stocks, and you'll see the healthy stocks will have that. However, sometimes there's a stock that is not particularly healthy, one that has a lot of short interest. And what those things will do is people will go out and they'll try to borrow the stock in order to short it so they can sell it to someone else. But it can become hard to borrow, in which case it might not be able to locate the stock to sell. And so investors don't have much of a choice. They have to turn to options. And so they say, all right, well, what we're going to do, since we're really short on this stock, we're going to buy puts on it. And we're going to sell calls to finance it. We're going to do a synthetic short stock, which is the opposite of this long stock position. But when you do that, when you're buying puts and you're selling calls, at a certain point, it starts to impact the market maker books, and they have to change the volatility in order to adjust to account for the risk they're taking on, which means that they're going to start raising the implied volatility, or the market really starts raising the implied volatility because people are willing to pay more for those long puts, and it's going to lower the implied volatility for calls because people are willing to sell. They're much more willing to sell puts. They're much more willing to buy puts and sell calls. So the market has to respond to that and has to kind of make it so it works that way. So we can actually see how this gets exposed in the stock being hard to borrow, and these are some heavy text slides. But basically, when you get a critical mass of those investors and they're so pessimistic and it gets hard to borrow, it inflates the put prices and it deflates the call prices. And there's a direct correlation between the implied volatility of an option and its price. That's why a lot of investors in the options space will refer to the pricing of options more by their volatility than by the price, because it doesn't really matter as the price moves around. You want to talk about volatility because a given options price doesn't really matter. The given option today could be 10% of the money and then 5% out of the money tomorrow. But when you care about the underlying stock, you don't want to quote specific option prices or specific option volatilities. You want to think about it in terms of the overall stock volatility. Now, what we do is we look for when there is a 10% discount on a stock. That just means that you can open that synthetic long position and you end up receiving a credit that's so much that your break even point becomes more than 10% below the current price of the stock. And so a good example here was we had a BP stock for back in, again, 2015, where you would receive $910 to open up this position for a total risk of, at the time, I think it was $6,900. It was about $7,000 for the position, but it lowered your total risk to $6,090 because you're receiving $910 as a credit for opening the position. And this gave a P&L that looked just like a long stock position, only this was the break-even point. I mean, this was the current price of the stock, which meant that if the stock didn't move at all, you'd make a pretty good profit. Like in this case, you'd collect $910, and then over time, you'd just be able to close that position out when you got to expiration, and then it would, that would just be cash. So people might look at this and say, "Oh, that's fantastic," but it's really not. It's a very it's a sticky situation to be in. And the reason it's tough is because what this is being, when the options are being priced, they're being priced using the current price, or at least that current forward price based on where they should be given any future dividends and the current risk-free rate and all of that. But they're being, the option prices, because the implied volatility is getting separated and the skews, it's treating the stock as though there's a dividend coming. And again, that dividend isn't coming. It's just that the only way to make sense of the option pricing for what people are willing to pay is inferring that the stock will drop by that amount between now and the expiration date. So let's step out for a second and take a look at a stock that I've kind of tracked for a while, which is Tilray. Now, this is a stock that, if we just take a look at, let's say, the 1 year history, I remember following this guy a while back, or maybe it was 6 months. I remember they were around 200. Here we go. They were over 200 at one point, and their forward price was like 150 for a 2 weeks out. And it being 150 for 2 weeks out was crazy because that meant that it was going to drop. But then, sure enough, it pretty much tanked and lost about half its value, more than half its value over that brief period. I mean, it just completely fell out. And so this was pretty legitimate view because the options investors, they weren't able to locate it to short, so they were buying up puts and they were selling calls, and that resulted in this skew. Now you see the skew differential here, and if we go into a specific trade, what I'm going to do is I'm going to reset our view so we can hopefully get something up here. We'll just say spreads. So the skew, if we come down here, you can see more in more detail the actual numbers. The at the money implied volatility for puts is over 100%, and for calls is under 70%. And this becomes untenable as an investor, because if you wanted to take, let's say, this $84 current price, and we go out to, actually, I'm going to come back up to the overview and take a look at the forward price to show you that there is no dividend coming, but when you can see this complete downward trend, which means that the option investors along the way, they're all very, very bearish about this. And sometimes you'll get this after earnings because people will be bearish, but just for it to go out, and if we go all the way to the furthest expiration, you'll see it just doesn't stop going down. I mean, the current pricing, if you're willing to hold for 2 years, is that the stock should go down from the current $84 to about $62. And that means if you're super bullish on it, then that's great. In fact, we'll just take a look at this 729 one. I'm going to go to the option chain, and we'll go to the 85s, and we'll just say we want to get a, we'll look at a synthetic long position. And this synthetic long, we'll hide this guy. As you can see, the break even is here. So in the event that it just stayed at the current price that it's modeled to move to, which is this $89. Now that $89 price point, that's taking in the current price of the stock and gradually moving it up over the next 2 years because of the risk-free rate of interest. So they're saying, like, this is the drift that you'd expect to see, that for anybody who's going to make investments, they'd expect to be able to match or beat this. Otherwise, they would just put it in risk-free investments. So this return being here, the problem is that 70% return you'd get, who would possibly take the other side of that trade unless they felt there was no way the stock would actually get there? And so that's the sign, that's sort of the warning flag. And what you'll see is, let me actually go back to an earlier price point. Let's go out to, let's say, June. Um, we do have a warning that comes up when we detect that 10% discount. I think we're right below. So yeah, we've got this underlying is hard to borrow for the duration of the trade. And so this is just one of those things to watch out for. When you see this, there's kind of two ways you should view it. The first one is you probably don't want to sell at the money volatility. Iron condors and butterflies and stuff. You probably want to avoid that. But if you are bullish on the stock, I mean, if you're looking that far out and saying, "Hey, I feel really confident," for example, let's say you take a look at this and you say, "I think that between now and January 2020, which is literally 1 year from today, if you're saying I'm very bullish and I think the stock will be trading between 100 and 150, which is not a crazy view for a stock between now and then. If you apply that, you can see the kind of returns you're looking at could be tremendous. I mean, you would get, because you're taking a huge credit to open the position, and then it's actually a long position that is traditionally a debit position. So you should be able to make a profit. If it moves up, you'll make a profit from being able to sell it. But even if it goes down, you could still make a profit. And again, we come back to the fact that there's no free lunches out there. So if you see this, you don't want to really trust it. But I think what we'll do is we're gonna watch this trade. So we'll just watch it because this will add it to a trade watch list, and then we'll be able to see. Since we were watching it here, we took a view of 100 to 120, and it's going to model that for us. And then anytime we can come back and take a look and see how it's performed against that. Again, I don't think we're going to necessarily open this long position trade, but it is there. On the other hand, what we could do is we could go back into that same view, and we'll go back to our search results. And what this is doing here in the breadcrumb is it's saying right now we're looking at a synthetic long trade analysis for this stock at this term. Now we could navigate, we could say, hey, let's see different terms for this same trade, or we can go back to the search results, back to the option search engine, and this will give us, for the view we were looking at, and you can see it says we're getting a warning here that the stock appears to be hard to borrow. So this will be a bunch of trades for that view. Now in our case, I'm actually very bearish on the stock. But the problem with the very bearish view is that it uses the implied volatility, or at least the mean of the call and the put implied volatility is calculated. So our presets will take our view for the future and say in a -2 movement based on volatility and a -1/2 volatility movement is our range. So they're assuming we're going to go down at least half a vol and upwards to 2 vols to model this pricing out. That gives us this low point of $15, which is probably too bearish. So I don't think we're going to like the trades we see here. So instead, maybe we'll just manually put in some information. You'll notice we got the forward price here, which means that the option market, if we were to try that synthetic long and we were to go back and look at it, the break-even price for it would be this 66.95. That's the forward price that we have here. And this is based on the price of a synthetic long at the money and where it would break even. So you'll also see a couple things here that I'll point out here is like the put break even. The put break even is an interesting metric which takes all the puts that are currently that from the open interest, which are the numbers from close of market yesterday, and it takes every put and figures out where it would need to go to break even based on its current pricing. So it takes the explanation here as well. It'll take the mean price point of actually on a specific put, the break even will be, let's say you have a put that's struck at 100 and the current bid ask mean for that put is $10, then that would mean it has a break even of 90. The person who's buying it would need it to go below 90 for a profit. The person who's selling it would need it to stay above 90 for a profit. So now we take that point for that option and then we multiply each option by its open interest and then find out basically the mean of all the put options that are hanging out, what that would be. And this is a good useful thing to point out to say, hey, if you're going long on puts, here's sort of the price point that people are expecting. And the reason that comes up is if we take a look at open interest, you can see there's a ton of open interest being held at really low price points. Now, these ones that are low here, they have a high open interest, but they also have probably relatively low cost because this one's probably like a 15 or 20 strike. And so this one is going to have low pricing, but it's going to have a good, it's going to have high open interest and so on up the chain. And the same thing goes for the call break even, which is saying based on all these calls out here, if you were to weight them by the open interest you have and the break even, what that expected price for the typical calls break even is. So you can see this massive range means that there's a ton of volatility expected. Now, this, of course, doesn't account for whether people are long or short or hedging or how they're doing it, but it is a pretty good gauge to get an idea when these numbers are so far apart that there is drastically different view of where the stock is going. The all break even is it's not generally it varies from stock to stock, and you'll want to track these over time if you want to get a feel for how it works in the specific stocks you're looking at. But this just takes all the puts, all the calls weighted the same way and puts it there. It's not a mean of these two. It's literally just throw all the option break evens in there and then weight them by your open interest. So that's there. So again, let's say we wanted to switch for this 1 year trade and we're going to be bearish. Um, I don't really know of the best way to trade this, so I would say let's look at this 66 or $67 forward price and say, what if it goes down? Let's price it for a range of 55 to 75, right? We want to find a good trade that kind of fits into that range. Now, of course, it's not going to try to nail that range, but we just want to know, uh, what are the trades that will do well within that range for the purposes of gauging it. And then the second thing we're going to do is we're going to uncheck to exclude our range bound strategies, just so we don't get butterflies and stuff in there. We don't want anything that'll profit up to a certain point and then start to lose us money if it keeps going in the direction. So we could see the best options here are covered puts, which is not too surprising. This is where we go short the stock and then we sell puts against it. We do need to have an option here. It's on our backlog to not to exclude the trades automatically that involve stock positions, because the point we're in this hard to borrow situation is because the stock's already hard to borrow. So what we'll do is we come in here and I'm just going to uncheck everything that would involve stock. Actually, all these are stock based because level 1 you're required to have that. And so we're looking at these trades here. Now, what's funny about how this works out is you'll notice that we're getting these bullish trades that are showing up. And the bullish trades are bullish for that range, partly because we're not being super bearish on our view. Now that I look at it, I realize I only went down to 75. Really, what we should do is we should use that $65 or that 67 here as our high end, go down to let's say 50, and this should give us some trades that are a little more bearish that we could track. And so we'll just pick one of them here. And these guys come up, churning through all the different options and everything. And well, again, we're looking at all these bullish trades. There may not be a bearish option for us here, which is a good lesson to hold on to, because the market's clearly already on top of this stock is going down. And as much as we like to follow the momentum, we like to follow the market where we can. We want to be prudent in following it. But sometimes you just can't force a fit. And this is a good lesson that even if we're we can be super bearish on it, but if the market is entirely already bearish, possibly over bearish at this point, then it's just too crowded for us to get into. And so I had hoped there would be something we could get here. Maybe if we switch over to midpoint pricing. This will use the options, the bid-ask mean, instead of the market pricing of buying at the offer and so on. See if we can get a better trade. Yeah, I guess at that point we're starting to see some better things. And then I like to filter these trades down when I have a specific view. I usually want to see trades that do not lose money within my view. And so in this case, here's a good example of a bear call spread. I believe the stock really isn't very liquid, so it's going to be, I'm assuming, yeah, the liquidity is probably off the wall for these guys. So if we took a look at the customized strategy, it's a shortcut, you can see there's a huge difference in the spreads here. I mean, it's multiple dollars between these. And it's a call spread, which is kind of interesting. What we'll do is we'll just go ahead and we'll watch it. We're just going to put it in. So now if we go to our watch list, we're going to see we've got 2 trades here. Another slight point to watch out for is because of the liquidity requirements or liquidity hits, because these things are so far apart, these numbers are not going to be super reliable in giving you precise returns, because they're going to say, hey, we open this by buying at the offer, selling at the selling at the bid, and then it's going to say if you closed this by, again, buying at the offer and selling at the bid. So as soon as you add a trade here, you should expect almost immediately that you're going to get a big negative. That's just the nature of us using market pricing for that stuff. So again, this was a pretty in-depth discussion talking about synthetic long, hard to borrow, and of course the discount and some of the other things about stocks that are super bearish. I'm going to take a look for tomorrow when we're going to have to deal with Starbucks one way or another, and then the other stocks that we've got on hand. I was tempted to put in a trade for Starbucks here because one of the things that I've noticed consistently is that if we take a look at the, the week chart, the week chart's interesting because you'll notice that it's been green most of the time. And what the green means is not necessarily that the stock is going up. I mean, often those are correlated, but the green means that it closed above where it opened. And you'll notice that it's green almost every day here because Starbucks has this habit lately, the trading of actually closing above where it opened. And so if we move to the daily chart here, what I'm going to do is I'm going to go out and take a look at the past week, full week of data. You'll notice that we had an open here where it opened down and then it caught a bid and closed up. And then this is overnight trading, pre-market, and then it opened down and then it closed up. And then this day it opened down, moved up a little bit, closed down. This day it opened down and then closed up. It shot up immediately, but then sort of sailed down. This is the one day where it actually opened above where it closed, like a honest to goodness, like red candle at the end of the day. And then today again, it opened really low, closed pretty high. So what we're going to do is, since it comes down here, this isn't super low, but in the event it's on its way down tomorrow, we were hoping to get some news from them regarding their China position because Goldman had a great report talking about how they really expected them to see a drop, but or at least them to be the next shoe to drop when it came to the China issues, like Apple had a couple weeks ago. That didn't happen this week as we had hoped. So what I'm going to do here is we're going to put a trade into close. Now, at this point, you can see if we wanted to close it with a market order, it would actually cost us more than if we just held on to it. And that's one of the risks around the liquidity. So what I'm going to say is, let's say we're going to try to close our book, which in this case is just that position. Now, in this case, you see sell to close that one option, buy to close the one we're short. We're going to see, actually, if I step back to the portfolio, we opened this at a 25-cent credit. So let's see if we can get lucky tomorrow and close it at a 25-cent credit. Let's see if we can just break even, if we can hopefully catch, let's say, good till canceled. Now, what I'm trying to do here is I'm trying to say, in the event that it has that drop again tomorrow or it opens low, sometimes you're able to get fills because of the current situation in the market. And we don't want to sit around and watch it every moment and obsess over it. Right now, we're okay with just taking the full loss on this if we need to. I'd prefer not to because it is a position that we own, that it's a call position, which means that it's going to get assigned, which means we'll get hit with the assigned fee and stuff. I'd rather close that out if I could, but it would probably cost us more right now to close it even at the full loss when you add in the liquidity than it would cost if we were to just let it assign. So at this point, well, actually, we could probably close it a little bit early now, but I'm going to put it in order that's a net debit to close our position as we expected. And I'm going to ask for 25, which is what we opened it for in the credit. And the reason I say good till canceled is just because I don't want this to be a day order. If it's a day order, I'll place it, and then in the next hour, it probably won't fill. Closes in 57 minutes. But I want it to be there for the morning. So if Starbucks continues to do this thing where it opens low and then kind of works its way back up, we'll be able to at least just cut out, gain back what we can, and call it a day. However, this of course could be leaving money on the table. They could announce the news, close the market today, or they could announce it overnight or during the day tomorrow. But we don't know if that's going to happen. And at this point, the plan was to use it for the delta. We'll take it if we can. Just at this point, we don't really feel too bad about our position with the current portfolio. So I'm going to put in the order here at 25 cents. See if we can close it back for what we bought it for. And then now we've got a good till canceled order at 25 cents. I don't know that this will fill. It probably won't, but again, we would take it if we got it. Now, we're putting ourselves at risk here a little bit because if we take a look at our portfolio Greeks again, we do want this we want this negative position. And right now, most of our, I'm sorry, we want a neutral position, and most of our negative delta across the portfolio comes from Starbucks. So if we do end up closing that on a day when the market's dropping, then we're sort of getting rid of the thing that we're hedging with. And that's, again, that's a risk that we're going to take, partly because we don't really see the signs at this time for the few hours that we're going to be around that the S&P should drop. I mean, it's been pretty good. Again, a situation where it went down, but with a green candle. We've had a lot of these days where the market opens low and then closes high. So we might look to take advantage of that as well, because one of these days we may open up an order early in the morning and then come back and see if we can fill it later in the day. Just day trade some options, but for the time being, we're going to leave things where they are. And I'm going to sum it up here. If you have any questions, hit us up at hello@quantcha.com. And of course, you can leave comments below. And yeah, I hope you guys are finding this to be useful. We've definitely gotten some good feedback so far, because I know the tools can be overwhelming, especially for investors that are coming from other platforms or new to options. I really recommend working with our paper portfolio if you're just getting started. You can just pick it from the drop down, and then when you're using this, you can just add whatever positions you want. You can say, hey, look, I already bought this, or I'm simulating a buy of this, and this way you have that in here. And then you can use the manage book feature, come in and say that you want to add options, pick a random date in the future. You can try to replicate the portfolio we're working with here. Let's go to the 110 calls. We're going to sell that. Now we've got our covered call. We can see, check that out. And then if you like the trade here, you can simulate the purchase just like we do with our trade button. There's a commit to portfolio button where when you click that, you now have in your portfolio that trade. And you can also, I think, edit these in line. We let you do that if you want to tweak your pricing or you want to add that stuff. And depending on who your broker is, we try to support most brokers through the import, where if you export your broker positions from a few of the major guys, you'll be able to just browse, select that file, import it, and we'll try to get it. In the event that it doesn't immediately import for you, just email us, especially if you can share that export file. We're usually pretty good about turning those around so you can get that stuff imported. And this is a feature that's available even if you're not subscribed. You can still use it, but the data is delayed 2 weeks or more for our unsubscribed users, so it's not as helpful, but it's still a good chance to tool around with everything and kind of mess with it and add options and all that kind of stuff just to see what your positions will do. As you can see, we're already losing on my fake trade. And at any time, you can come in here and just whack out everything you have and start fresh. So, yeah, just wanted to show you that real quick. We get some questions about that. But the reason I suggest working with the paper portfolio when you're getting started is because it won't cost you anything. Those red numbers won't actually hit your bank account. Of course, once you throw your portfolio in there, the game is on. But I'm going to wrap up here. Hope everybody's doing well in the market. And as always, good luck and good hunting.